and how you got to be a part of this wonderful opportunity.
So I'm Dan Handford. I'm one of the managing partners of a real estate private equity group out of the Carolinas called PassiveInvesting.com. Yes, that is actually the name of the company. And we did buy the domain for the purpose of the actual company itself, which is great for those of you who are active and you're thinking about your company name. We actually had a company that was a different name called Handford Capital, but when you go on podcasts and do interviews, a lot of times it's hard to really spell Handford, and also the word capital, some people spell it with an O or an A, but think about that when you're creating your own names for your companies as well. But we actually have just over $380 million in our portfolio and have just under 3,000 units. We primarily go after Class A, suburban Class A, as well as B plus assets with some value add. And just last year, even during the pandemic, we were able to raise just over $61 million and acquire a little over $156 million in assets. So.
They can't spell Handford. They certainly won't spell Hasm. So Handford's not too difficult. Robert, tell us a little bit about yourself.
Hi everybody, my name is Robert Martinez, and first thank you to our host. This is amazing. I'm so excited. I was stir crazy. So it's so fun to get back into the norm, and thank you to my team here at Rockstar Capital for being here with me on a Saturday. Again, my name is Robert Martinez. I'm the founder of Rockstar Capital. We are based here in Houston, Texas. We started in 2011. Today we own and manage 22 communities, 4,200 apartment units with an asset value of $420 million. Our claim to fame is that we return a lot of money to our investors. We've raised $120 million in the last 10 years. We've had 13 cash out refinance events that have resulted in a 100% return to our investors. I'm a two-time National Independent Owner of the Year.
Thank you, sir. Kenny?
Well, he stood up, so I better stand up. Anyway, you guys have heard a little bit about us, but Wolfe Investments, we're about $280 million in assets right now. We've got 22 multifamily properties, about 19 as of yesterday, triple net properties, and it's ground up as well. So we do all that, about $57 million in 2020. Got a whole bunch lined up for this year as well. So excited to be back in person like Robert and see everybody here.
Great to see you, Kenny. Thank you very much. Mr. Suttles.
All right. Well, just honored to be up on this panel with these guys. Obviously, they got a little bit more assets under management than us, but Ben Suttles, Disrupt Equity, we got about $100 million in assets under management, mainly focused on Class B and C assets here in Texas, as well as in Georgia. We love Atlanta. We also have vertically integrated property management houses, as well as some other businesses as well, but hopefully we can add some value today.
Dude, this is your show. What do you mean? Nobody shot at
You guys did such a great job getting on stage here.
All right, thank you very much, gentlemen. This is a enjoyable group. I think you'll hear some nice comments. I'm going to sprinkle some questions around all four of you, but the first question I want to address to each one of you. Let's talk how your investment strategies changed over the last 12 months. What is different today than a year ago when we sat here together?
Well, I guess I'll get started and kind of go down the line. So I would say that one of the things that our group did even before the pandemic, which of course we couldn't have predicted the pandemic, is in the early part of 2020, we pivoted our focus from focusing on Class C and lower and B assets to the higher quality assets. And it is definitely proven that it was for us, it has been definitely proven that it was a good decision for us to do that, especially what we have seen in some of the lower end assets having a more challenging time with COVID. But as far as like underwriting is concerned, even in these higher quality assets, if we're doing a value add approach, or instead of doing a normal 12 to 18 month stabilization, we've expanded that to 18 to 24 months. We're hoping right now, obviously everybody's hoping that we're kind of at the tail end of COVID, so there's going to not be as big an impact as what we're thinking, but we still want to make sure that we're planning for the worst. And so we make sure that we have plenty in operating reserves to make sure that we have to weather any type of storms. We have the ability to do that. So we've increased our operating reserves. We've also increased our stabilization timeframes for doing renovations, as well as if there's a lease up side of the property, then obviously we're going to be increasing the stabilization timeframes there. And so those are kind of the main things that we've looked at. And we also, I'll tell you, the deal we did at the beginning of last year was a challenging one for us because we got a deal under contract. It was actually our largest equity raise. It wasn't the largest deal we had done yet, but it was a $49.955 million deal. And we were raising $19.4 million on that one because got under contract in the beginning of March, and then towards the end of March, of course, we all know what happened, the bottom kind of fell out of the market. And because it was a higher quality asset, it still made sense for us to move forward with our investors, and we were still able to close that one within the 60-day kind of time frame and close it on time. So, but those are kind of the few things that we've done as a company to make some pivots during COVID.
Thank you, Dan. Robert, how about yourself?
Yeah, my singular focus is to protect the 120 million that have given their family money, their kids' money to me. I have investors that are sitting right there. Everything I say will be factual because they're right there listening. My focus is that money because it's also my kids' money. It's our future. And so we shifted from acquisition to operation only. Very fortunate, we're good stewards of our money. We had an average of around 6 months reserves in our accounts. We were prepared for it. I think what COVID did was, it was the best thing ever happened to us because it ended habits. It forced us to go back and look at operations, strengthen the foundations, and we got really, really tight. We still had 3.5% rent growth. We had 7% revenue growth and 9.9% NOI growth last year. But that came because we had to focus. We did not purchase a deal until November, blew out our investment strategy, but we focused and we took care of our investors. And we learned a lot from the government. They're going to help. This isn't like the recession. Who was here in 2008? Raise their hand again. All right. This kind of event separates the good operators from the bad operators, the wartime generals from the peacetime generals. You got to be prepared for that. Then one thing we realize is that our tenants, they will take advantage of the system. They will go out there and they will take advantage and not pay rent. We have people that have been there for months that have not paid rent. Yet we see brand new cars in the parking lot. Yet we see brand new Samsung boxes by the dumpster. Well, they're unaware because they don't know what they're signing in their lease contract. And in the back of the lease contract, there's a state that says you can do landlord liens. Now, you may be very afraid of that. We may not be able to evict them, but I can apply pressure. There has to be an adult to pull the pacifier out. So we start our landlord liens at our communities. And guess what? Our delinquency balances are going down. People are all of a sudden coming up with $5,000, $6,000 balances, and they're paying them off, all because we apply a little pressure. So that's what I'm talking about. You just got to you have to invest with someone that has been there. Landlord liens were very common in 2008 to 2011, and we brought them back to life this year.
Thank you, Kenny.
Yeah, so we're in multiple states. We're in 4 different states on multifamily. So we focus on the landlord-friendly states, like Robert said, to do. So we've done that, but we saw rent growth in 2020 in Ohio and Texas on our local properties. Both of Ohio and Texas, all of our delinquencies almost nil. And so you just had to know how to, look at the system, work with your tenants. Those that made payment plans, almost all those are caught up. And then you have to be first in line for rental assistance for those that chose not to make a payment plan. So anyways, we work both systems. Properties did just fine. We acquired some new stuff. We've also been picking up some A-class properties as well in actually downtown locations. So we feel like A-class is definitely a place to go. We still buy D-class as well. We're very opportunistic and always have been for the past 10 years. The deal just has to make sense. It's got to be landlord friendly and have kind of the growth in that city and rents increasing, all that demographic stuff as well. But just we've just been focusing on on acquisitions, mostly A, picked up a few D's and C's, and kind of in between.
Thanks, Kenny. How about you, Ben?
Yeah, to second what Robert was saying, I think you have to really kind of look back and say, are my operations buttoned up? Because with what has COVID shown us, there's some cracks in the system. And, some of the people that, that are our residents, really, they're having some rough times, right? And so we had to pivot almost very, very quickly, come April, March timeframe, and, obviously provide value to our tenants to show them where they could get some relief, right? Places that they can apply. And then ultimately, what's happened on the property management side is we've also had to kind of pivot from doing the day-to-day, leasing and collecting rents and doing work orders. So now we're almost, playing, here's the rental relief, filling out applications, doing a lot of different things that normally a property management wouldn't have to do. So from an operations standpoint, it's completely changed, I would say, right? From an acquisition standpoint, so I'm going to kind of, second what Dan said, we're trying to kind of get into some nicer, newer assets, right? Some people that could, potentially weather, working from the house, right? Being able to take meetings from Zoom. I think that obviously that retail sector is still going to bounce back, but it might take some time, especially in some of these markets that we're in, right? We're in South Atlanta, and some of these people were severely affected, right? But so it's changed both from an acquisition standpoint and an operation standpoint. I think the next 10 years, I think we got a lot of boost, from say 11 to, up until COVID, from the government and just easy money and easy appreciation. I think this is going to be the decade of the operator. And so you have to realize whoever you're investing with needs to have their operations buttoned up. And, and as an operator yourself, you really don't just assume that the market's just going to be able to bail you out. You need to have those reserves, right? You need to make sure that your business plan is solid. You're no longer going to be able just to lob in offers and then hope for the best. It's just not going to happen anymore, right?
Thanks, Ben. Two things, guys, I'll mention to you just kind of my assessment early on is, it's interesting to hear these panelists talk about how they look at this as a positive opportunity for continued success. There is a segment of us who look at this and say, gosh, it's overwhelming, it's too much, it's unknown. And then there's the other that says, this is how we grow. This is how we become successful. This is how we separate ourselves from the pack. You guys have done that. I anticipate you'll continue to do that. Please, if you don't mind, in reverse order, I'll start off with Ben on this question. Talk a little bit about what markets you're looking at 21 and how they may have changed, whether COVID related or just as far as what markets intrigue you going forward.
I don't think it's really changed. Other than really making sure that they're landlord friendly, because I think in some cases you're in landlord friendly states, but maybe not landlord friendly cities, right? And so, I'll give an example. We love San Antonio, but it's been a little bit of a challenge there, right? Whereas in some of the other metros, they're starting to kind of open up certain parts of the eviction process and working with landlords a little bit more. So, that might make us pivot a little bit, but we still love the overall markets that we were in, right? Texas, Georgia, and Florida. I don't think that that's going to change. Ultimately from a long-term macro perspective, they're all going to have the things that we're looking for, right? Not only the landlord-friendly states, but tax-friendly, right? The population growth, and the job growth. Those are the things that you need to be looking for, right? Because that drives demand for rental product. And so that obviously allows you to push rents, So, I don't think that that's really going to change moving forward. The only thing that I'd say is, obviously getting in a little bit maybe nicer assets, but beyond that, that's what we're going to be doing.
So what are you looking at, Robert, market-wise? Yeah, no, I'm not going to go anywhere. Stay on your toes.
I'm going to echo his thoughts. I think it needs to be a red state. You've got to be playing with a set of rules that you can operate in. It's important that the tenant understands what their requirements are, and then we, on the other side of the contract, have our requirements. So as long as government doesn't interfere, that we want to be there. To borrow a expression from my friend Hannah, as long as the outcome is income. I want to be in a state where I can make money for my investors. I want to be there. We have 22 assets, 20 here in Houston. And I like that. I like that we're there. I like that we're in Wolfe. We're the 15th largest property management company in Houston. We're recognized there, and guess what? I get staff share. And when you get staff share, you can do really, really well. You can borrow, you can share ideas. I don't have to relearn the submarket. So, one of our areas, we own 73% of the workforce housing. That's 8 properties. We've had a tremendous amount of success that way. So we are venturing now. We have assets down in Corpus and down in Kingsville. I like South Texas. What brought me there first was I wanted to run away from the tax man. If you all were here last year, you heard me talk about some. You heard me. I'm not going to bring up Mayor Turner. That was 2020. I won't do it again.
Yeah, he's not back this year.
He's not here. No, but the tax man was doing a number on us in Houston, and I want to continue to grow. So we went to areas where the tax man wasn't as crazy. And now we have issues with insurance. So we've got to figure that out as well. I don't see where he's at, but look up National Flood Experts. They helped us a couple years ago, and they were able to help us remove. There he is. Oh, that's the guy right there. That guy saved us tens of thousands of dollars off of our flood policies, which brought our insurance down, which made our NOI grow. So I think you're going to be presenting a little bit later today, right? Yeah, there you go. And so it's really important to put yourself in a position to succeed and understand what's working against you and be in areas where that can be mitigated.
Thanks, sir. Kenny, I will come to you now. Talk to me and the audience, please, sir, about why you structure deals a particular way, how and why you structure a deal a particular way.
So we're a little bit different on that. So we don't do any upfront acquisition fees, but we also don't do a prep. So it's a straight 80-20 split, cash flow. 80-20 of refinance proceeds, and on the sale, 100%, investors have to get 100% of their initial equity back through the refi and or the sale. And we do it that way because we're a longer-term company. We do try to do a capital event by year 2, but that makes us always aligned and incentivized along in the same way that our investors want to invest. So.
Excellent. Dan, is your strategy similar, or can you talk about how it may differ?
Yes, it's definitely different. So one of the things that a lot of our investors are pointing on our investments is the tax advantages of it, right? And so when we're using cost segregation, obviously we can accelerate a lot of the depreciation and front load for the first 5 years. So most of our assets are going to be modeled after a 5 to 7 year hold. So we're not a long-term hold type of investor. So we typically structure them with a 2-tier structure. So we usually have a Class A investor share, and then a Class B investor share. Class A is usually a pref piece, or it's always a pref piece, and it is usually 9%. So, and we also have a secondary class, which is our typical structure, where we'll do 70-30%. We'll still have a pref in there, usually 7 to 8%. And then there's also a secondary hurdle in there, as a performance hurdle based on whatever metrics we choose on that particular investment. And then the investment would split from 70-30 to 50-50. So that's kind of how we do it.
Excellent. Thanks, Dan. This is a question I'm going to ask each one of you because it's really one of the most entertaining in my eyes, I think in the audience eyes. Talk to us about the hairiest situation that you've gotten into. That can be either with your investors, that can be internal, that can be with an acquisition. You pick, tell us the funny stories. I think I've heard about tarantulas and bathtubs full of God knows what. So the bar's high. Who wants to go first? Kenny looks like he's ready with a horror story.
We got a lot of those.
Yeah, go ahead.
My favorite are the animal stories that we had at the property. So we owned a property in Colorado Springs for about 3 years, but so a lot of that we had bats in the roof. And so we actually they were protected. So we had to wait for them to migrate to Austin, and then board everything up, and then we can get them out. And that same property, our manager looks up and there's kids playing with a black bear cub in the parking lot. She told them, what the heck are you doing? And then the final story from that property is that there was a mountain lion that took up a den underneath our office. So we had to call wildlife control and all that. So we lots of animal stories about ownership, and then also obviously the people stories are funny too, but some of those you have to make sure you don't say the names.
You set the bar high. Thank you very much for starting off that way. Can anybody eat bats and cubs, bear cubs? Robert?
Yeah, I'm going to go in the other direction, because the other part of the question was Suttles transaction. There's plenty of those. That's property management. That's every day. Total transaction. Last year we walked away from 2 deals. And that was very hard for me. I've never done that in my 15 years that I walked away. It was in that 2 weeks of fighting the curve bull crap that they told us about. It was that time when I didn't know what was going to happen. We actually were at the due diligence stage. We were hard on our money, and I didn't know what was going to happen. And I really wanted these deals, but I couldn't put my people, I couldn't put us at risk. I didn't know what COVID was in March, April. So we walked away. We lost $50,000 of earnest money on that. I lost $50,000 of earnest money on that. And that was really disheartening. And then we had a second deal where I was about to send the money. I'd signed the PSA. I had not wired the money yet, and we walked away from it. And if you've been doing this for a while, and you want to pride yourself that when I get into contract, we're going to do a deal, and to not be able to do that really bothered me a lot. I'm talking about it right now. I don't like losing $50,000, but I'd rather do that than put my people at risk, and certainly put our investment capital at risk.
Thanks, sir. How about you, Dan?
So I'll go to a property story because that's the one that comes to mind. Maybe we'll see if it tops Kenny's. So we actually had a resident who was running a wood shop in one of the second bedrooms. And you can kind of imagine what happened here, but when we walked in, it looked like a murder scene. There was blood on the walls, there was blood all in the kitchen, the cabinets, everywhere, floor, ceiling, everywhere. And what happened was he was in his wood shop and cut one of his fingers off and just ran swinging around all over the room. Of course, when we go in there, we're thinking like somebody died, but he didn't die. He just got his finger sewed back on and everything. But that was one of the crazy stories we had at one of our properties. So.
All right, raise your hand if you think Kenny's in the lead. Nobody? 1, 2. Chopped off finger. Looks like that's winning. All right, Ben, beat them both.
Oh my gosh. All right, so we've got drug dealers, shootings. If anybody's been invested in South Atlanta, it could be a fun time. So we have this one property that I talked about actually last year. Gosh, I can't believe this was 12 months ago. We bought it. It was our first deal in Atlanta. It was a little of a transitioning property, I'd say, in a transitioning area. And, you know, I walked on there, within 5 minutes I saw a drug deal go down. You know, and then I'm pretty sure that there was definitely some hookers that were propositioning people kind of rolling in, because they'd roll in, the woman would kind of go down. She was either dealing drugs or she was doing something, right? You know, so we knew we had a beauty on our hands. You know, so within the first day, we had the security on, and I guess there was a lot more going on, because once the security kind of showed up, about 20 of the tenants left. But, you know, ultimately, you know, we were able to get the drug den out, get the hookers out, and we ultimately ended up, you know, turning it into a great community, you know. But, yeah, it was a little bit of a rough story on that one.
Thanks, Ben. Thanks for sharing that. You know, there are a lot of conferences like that, or like this. People come with the idea that you're going to get the magic answer. There is no magic answer, I think, is really probably what most of you would share. But beyond that, let's talk about your creativity. How have you gotten to consummating a deal with whatever party it was in a very creative way? If you could share to us, what's the most creative way you've gotten a deal in your experience? Dan, we'll start off with you.
I'd say most of ours aren't very creative or unique, but one that comes to mind was our very first deal, and it's kind of how we ended up getting the deal. And I have a mentor in the space that I have been coaching with since the very beginning to help kind of reduce the learning curve and get to where we want to go faster, which is why I recommend everyone in here having a mentor, whether you think you can do it on your own or not, because I think anybody in here could do it on their own, but it's how fast you want to be able to get there. But the very first deal that we did, we underwrote it, we toured the property, we put an offer on there, got into the best and final, and they ended up awarding it to another group that had bid it up by another $200,000. Wasn't a crazy amount, but we had our strike price, and we're going to go up above that because we knew what we wanted to be able to provide to our investors. And so we walked away, right? Because they wanted us to go up, try to meet that or whatever, and we didn't. And 4 weeks later, the phone rings, and it's the broker on that deal saying the original buyer that was on that property never even got to the point of signing the PSA because it was so challenging to deal with. Would you be interested in buying the deal? Of course, my first inclination is I had all the leverage, right? Because I'm thinking, now I got them because now I can maybe reduce my offer price or do something that will allow me to be able to get a better, spread, if you will. And one of the things I did is I called up my mentor, and the phone call lasted 1 minute and 47 seconds. I'll never forget that because my mentor is very direct. It doesn't pull any punches or anything like that. It's very direct. I made a phone call to him, told him the scenario, and I said, I feel like I have all the leverage. What should I do? And he said, if the numbers make sense at your last offer, do it at your last offer. He said, for one, you're going to make the broker's life easy, so the future you can get future deals, which has proven that up to this point to us. But he said, just get the deal done. And so, minute 47 seconds, great, no problem, do it. Deal still made sense at the price we were buying it at. Submitted the offer on that, and of course, got the deal. And come to find out, about 6 months ago, I was sitting down with an investor group out of Charlotte. So I'm based out of Columbia, South Carolina. And they were sitting in my conference room, and they came down just to kind of introduce themselves and kind of start a dialogue. And they said, now, are you the owners of that deal, the name of the property? And I was like, yes, that was one of ours. And they said, we really hate your group. And I'm like, why? And they said, because we were $20,000 less than you. And of course, I'm thinking about that going, I'm very glad that we took it at the offer that we originally did, because if we didn't, I'm pretty sure I would have gone down less than $20,000 or more than $20,000. So we would have probably lost that deal.
Thanks, Dan. Robert, how about yourself?
Yeah, sorry about that. Yeah, where there's a will, there's a way, for sure. And that's true in business, that's true in life. You want to find a way, you'll find a way. We wanted to expand outside of Houston. We wanted to escape the tax man. There was a great deal in Kingsville, a Class A deal. It was operating well. It's got some big, good presence with the school system, with the DPS officer. There was a lot of great reasons to buy that deal. But there was a lot of competition. A lot of competition. And you need to understand who your seller is and what's their trigger point. And there was another deal that they had a few miles down the road in Corpus, outside of Corpus, that had been struggling. And had been struggling for a while. Another Class A deal. It's a great construction deal. They had some management issues there. And we were able to get a hold of them and say, hey, listen, we'd love to buy Oak Tree, and I understand that you have this other deal that you have that you're struggling with. What if we take it off your hands? Can we get this deal wrapped up right now and avoid all the bid process, avoid all this 11 offers you're gonna get? We'll take your problem deal, and we want the cherry deal. And we knew that we're not just gonna buy a bad deal. We had a strategy. The strategy's proved pretty well. Sam's right there. We'll talk about that later on in the property management panel. But we're gonna walk away with some of that deal 2 years later and walk away with 50 to 60% return because we bought that deal. So anyway, it was an opportunity for us to expand. South Texas, we picked up about 500 units, and we're really excited about that.
Thanks, sir. Ken?
Yeah, we've done some lists like Dan, we were second place, and then they came back because the other group couldn't close. But today, some of the most creative things we're doing is there's a lot of scared office folks right out there today. So we're actually doing a couple deals right now where we're going to come in, bring some equity, and repurpose those office buildings to multifamily, right? So there, 2 of those 5 we're working on right now. The owner's going to lead equity in the deal, so they're going to make some money, not lose their shirt like they're scared of. But then we can both win and make some beautiful real estate.
I hope so. As a banker, please help us with office. Ben, go ahead.
Well, yeah, I mean, most of our stuff's pretty vanilla, right? But I would say, to an earlier point, I'll give away a little bit of our secret sauce. I think, when it comes to price, right, that affects the returns that our investors have. So we're pretty much, hey, this is where it's at. Maybe I'll give a little bit of wiggle room if we're investing final, right? But where I can kind of tighten things up is terms. So, that's one thing to kind of differentiate yourself, especially when it's a highly competitive, bidding situation. Sometimes, you're at 30 days due diligence. If you come down to say 15, maybe that'll push it. Maybe, obviously the hard money can, obviously if you want to do that, I'd say not all markets that is necessary, but that could, be a creative way to kind of get your deal across the finish line, right? But, pricing, keeping people in the deal, we're open to all that, right? Especially right now, I'm opportunistic. You've got to look just like what Kenny does a great job of looking at where, people might be fleeing and, hey, is there an opportunity that we can make this thing work? And I think that's how we kind of look at deals too.
Thanks, guys. I'm going to take a few from the audience. Some of them are specific to each one of you. Some is maybe for the panel, or raise your hand if that's one that you want to tackle. Robert, I'll start off with you if you don't mind. You had mentioned landlord liens a little while ago. Somebody wants a little bit more information about that. Could you tell us what you know?
Yeah, I mean, you have the power. You are the landlord. You just need to read the back of your lease contracts. It says there that if they don't pay, you have the right to go into their apartment and you can leave their stuff. And so you're making my life hard. You got $8,000 balance. I have to worry about your delinquency. You're using our resources. You're parking it. You're there in the parking spots. You're not paying your water, trash, and your gas. But you think you can continue to squat? Well, you're wrong. You can go into your apartment and we can glean items of value. So I've told my team, again, my teams were scared. They had me. I said, I will take the bullet for you. I will go on the news if this hits the news. I'm going to do it because the lease contract says that you can do this. We've gone in there, we've taken those brand new TVs. We've taken the PS5s. I did this before from
That's bold. That's bold.
Well, you know what? It works. What has the expression go? Action to the balls and find out. But anyway.
No, hold on. I've got a list of expressions. I'm naked on glass and pacifier, the adults, outcome income.
Well,
I need to hear that one again.
But it is. Look, they owe rents. We've done our job. We provided quality housing. Everything works. We actually put brand new air conditions in every one of our units when we take over because we believe in basic services. There's no reason not to pay rent. Now, obviously, we have payment plans set up. We understand who's there, but we find out they have brand new stuff. We're going to go get it. Guess what's happened? They've either left, which we got the unit back very quickly, like in 2 days. Right? They lost their TV. These guys are serious. We're out of here. Right? Or they come in with $4,000 and paid off. So, somebody has to stand up and be the adult and remind them that they live in an adult world. I have 120 million after the tax. I'm not going to sit here and wait for the government to kick back and keep pushing the eviction moratorium. Okay, maybe I can't evict you, but I can make it an income. I can.
We can clap for that. That's all right.
Anybody else want to talk about landlord liens?
I'm just going to say that's bold, but I like the idea.
Mayor Turner, right? Come on, I'm going to do landlord liens. It's the right thing to do. It is the right thing to do.
I want to touch on this a little bit. I've talked about this to several different people, right? why is it fair to us as landlords that we have to subsidize housing when the grocery isn't subsidizing people's food, right? The doctor's not subsidizing people's health care, right? It's not fair that we are the only people in this whole industry or the economy that seems to be the only one left holding the bag, right? And I think I know why that is. I think everybody's, Daddy Warbucks, and we're all billionaire hedge fund, owners, but really all of us are mom and pop, investors and operators. We're just trying to make a living, right? And it's not fair for us to be holding the bag. So, I won't get into politics, but I do agree you have to stand up, because otherwise I think this is just a slippery slope. It's just going to keep.
Look, there's been extended unemployment benefits. They're getting, how much money are they getting now? I forgot, it's like hundreds of dollars per week. You can make more money staying home. Unemployment's at 6.4, 6.8%. That's less than what it was during the Obama years. This was the economy not too long ago. You can pay your rent. And I know that they have the money when they come in and they pay $4,000 at a time. They get their TV back. I know it. And guess what? They have the new financial aid package here in Houston. We are making it required. We are pushing out to our managers saying, here's a chance to clear your balance. The government's giving more stupid money away. Clear out your delinquency. And if you have a CDC contract, by the way, I think 80% of those people that have that certificate are lying. I really do. Because once we apply a little bit of pressure, once we say, hey, you know what? We think you're lying. We're going to get our attorney involved. Guess what they do? They leave. They have protection, but they left. All with under a little bit of a pressure that we might get an attorney and go after them for lying.
Thanks,
It is a game.
Thanks, guys. Let's switch topics a little bit. Let's talk about distributions to your investors. What's that look like? When did you stop? How much did you stop? What kind of communication have you had with them over the last 12 months? Dan, you might start with you, sir.
Sure. So when the pandemic first started, one of the things that we did is we've always been doing monthly communications on each investment that an investor is invested in. So they'll get a monthly email on the performance of the property from the prior month. Well, during the pandemic, of course, we knew we were going to get a lot of questions from investors, so we actually converted from monthly updates to weekly updates, and updating them primarily on the collections, because that was the biggest concern, right? And so we did that fairly quickly so that our investors were not concerned. And thankfully, each one of those were, of course, they wanted to know where we're going to stop distributions. That was one of the biggest questions is, are we going to be able to maintain distributions? And all of our assets are very well capitalized and have plenty of operating reserves, and we didn't see a major drop in our collections to the point where we really needed to get into a cash preservation mode. And so we have non-stop distributions on any of our assets. So we have maintained distributions throughout, and we actually do monthly distributions. So every month we're looking at the financials to see, is it still a good time to be able to do that? So 2 of them we have converted from monthly to quarterly, just because there might be some unknowns that might happen about what's going to happen with those properties. But we have still maintained distributions throughout the time.
Thanks. Robert?
Yeah, the same thing. I think if you're a strong operator, you're a good steward of your money, you have 6 months reserves like we did. During a time of crisis, communication is key with not just your residents, but your investor base. We very, very early on told them we are not going to discontinue distributions because we had money in the bank, because we have strong collection practices. We're not going to do this. Nothing has changed for us. And we're often going to lose a quarter's worth of our reserves because something catastrophic happened in the future, but it's my job to keep the consistency, to keep the cash flow going. The investors that gave us that $120 million, they rely on them, and then they're retired now. And they expect that check to come. So I'm going to do everything I can to keep it going. So last quarter, we did $1.4 million. It's great.
Thanks. How about you, Kenny?
So we took a different approach. We kind of clammed up just to make sure we knew what was going on. All the properties were operating cash flow positive. So we did a large kind of catch up in August. We felt like it was time to kind of get back to that. And then we're back to quarterly distributions on those.
Excellent. Thank you. How about you?
Yeah, I think it's a little bit of a hybrid, right? Once, March and April kind of came around, I think everybody was scared, right? And so I think we did we turned off the spigot for the properties that we were doing distributions on. But, we're getting back to that monthly distribution cadence, right? Because, we have more workforce housing, and unfortunately, those first 6 months of the pandemic it hit our residents, so that stuff it's better to have some extra cash on the side in case the thing was going to drag out, or we're going to have this, tsunami of evictions, which everybody continues to keep thinking is going to happen at some point, and so we're reserving cash in case we had to evict people all at once, right? But, I think most of the really bad news is behind us, And so we are starting to kind of, turn that back on for the properties.
Can you, either of you own a PS5?
Do not.
We're gonna be having an option soon.
Fair enough, I don't either.
They've been bubble wrapped and put in storage.
We'll be by your booth, sir. Hey, want to talk about one more thing as the volume of investors and maybe opportunities that have been looked over in the past 24, 36 months has increased substantially. Tell me a little bit about what you think about going to smaller markets. Is there some potential there? This is coming from the audience. More specifically, it seems like a competition in metro is prohibitive. Good strategy to go to smaller towns, in your opinion?
That's all the town. How small are we talking about?
You answer how you see fit.
Well, so we've been buying a lot in Longview, Texas, Wichita Falls, we're buying a deal out there, so we're okay going to, smaller markets in Dallas, but we're still buying Dallas, it's just a different game. We've moved on, we're pretty opportunistic on by the city too, so, that's what I'd say.
Yeah, I mean, the smaller the market, the better the operation better be. You better have somebody there local. You better, we're real fortunate down in our South Texas group. We have Camden. Camden put out South Texas. We hire their people. We have great staff around there. Those are our best performing assets actually because they're in the smaller markets. Good management leads to good results. No taxes issues, no insurance issues. It's what brought us here. It's why we're still continuing to look for activity there.
Actually, I want to piggyback on that. I do like the concept of going to some of the smaller markets, as long as the economy is there, right? Because those appraisal districts are not going to be as aggressive as, say, Harris County or Tarrant County or whatever. So, but that shouldn't be the only reason that you invest in them. But, I think you just have to look at it market by market, right? There's some markets that, maybe look strong prior to COVID, and maybe don't look as strong now. You are going to have less competition, but as Robert alluded to, the talent pool in these areas is going to be a lot more shallow. So, a lot less vendors, a lot less managers that you can potentially pick from. And so, just, pick wisely. But yeah, absolutely we'll look at deals in secondary and tertiary markets.
Thanks. I'll go ahead and add something to this too.
Please, sir.
So we actually don't like the smaller markets. So if you're getting started, for me, I don't think it's a bad idea to start in a smaller market. But we are very cap rate driven when we try to determine the strength of a market. And so we want to make sure that we are buying properties and assets that actually are in low cap rate markets, in low cap rate environments. And some of you might be thinking, it sounds kind of counterintuitive, maybe some of the books that you've read that say to try to find like a 7, 8, or 9% cap rate buy-in or even higher than that. But if you understand how cap rates work, the higher the cap rate, the lower the competition in that market. Of course, the lower the cap rate, the higher the competition is. Well, I want to be buying in markets that I know is going to have a strong competition when I have an exit as well. And so if you kind of do an analysis here, if I have a similar property in a strong 5% cap rate market, and I increase the NOI of that property by $100,000 over, say, a 5-year period of time, in that 5% cap rate market, I've increased the value of that property by $2 million. But if I do that same thing, same amount of time, energy, and effort, and I do it in an 8% cap rate market, I've only increased the value of that property by $1.25 million because of the exponential benefit of buying inside of the lower cap rate market. So I'm not opposed to buying inside of those smaller markets, depending on what your situation is, but for us and our investors, we want to make sure that we have a good solid exit on the other end, and that's one of the main reasons why we go into some of the primary markets and also inside of some of the higher end kind of secondary markets as well.
Thanks, Dan. We're almost at the finish line. Robert, give me a glance. You want 10 seconds or something?
I was like, at the end of the day, cash flow is king. I love no competition because I can go in there and dominate. Simple as that.
I was just going to ask Dan, where are these 8 caps at? Come on.
When I'm talking about competition, I'm not talking about competition with the other competitor properties. I'm talking about competition with the buyers. No, I want buyers to be there to be able to acquire the property. So it's not me not wanting competition for like other properties in the area, even though you're going to have that in a smaller market. But that I want to have a competition of having 30 or 40 offers to choose from versus 10.
An awesome panel when you get 4 people up here willing to share all their experience and expertise and willing to disagree in front of one another. It's a different strategy, a different philosophy. I know the respect is great amongst one another. Thank you guys for being here. Let me mention a couple of things. Stand up if you're a syndicator.
Come on, don't be shy.
Okay, great.
That's what I like to see.
I'm getting questions, you can see questions that talk about opportunity zones, that talk about moratoriums on evictions. These are the conversations that some of your fellow attendees want to discuss with you. It's not only for these 4 people, so please keep those topics on top of your head, share them with one another. Give me a round of applause for these 4 individuals.